Following the interesting session on bank finance, our discussion now will be on alternative finance. And we have a great panel for that. We have with us, first of all, let me say, I'm Kalliopi Karaiskaki from the law firm of HFW, Holman, Fenwick, and Willan. And we have with us Robbert Sougé, Managing Director in Direct Ship Finance. Did I pronounce it correctly?
Very well.
George Fikaris, Managing Director in EnTrust. Jeremy Dean, Principal in Hayfin-Breakwater. Mike Kirk, Co-founder and Managing Director in RMK Capital. And Stefanos Fragos, Chief Representative at the YieldStreet in the Athens branch. In our discussion, we will not cover forms of alternative finance that may have been covered or will be covered in other sessions of this conference, but we will mainly focus on the offerings of our panelists in combination with a general discussion on alternative finance. So let's start. Let's start basically with your offerings. So, Stefanos, shall we start with you? I understand you may also have a small video to show us.
Yes, indeed. Cal, many thanks. It's a privilege and an honor for me to be here in front of such a distinguished audience and distinguished co-panelists. I'd like to start with a short video just demonstrating the strength of retail distribution. So if we can please start with the video.
Happening at 4 p.m. Eastern Time. What you see here is our platform. What we're launching at 4 o'clock is an investment in our art finance business. So it's a $10.5 million investment, and as you can see, 100% of it is remaining. It's going to launch in about 2 minutes, and we will see what happens. So there you go.
Wow.
So there you have it, guys. 470 investors, 11.72 Kark.
That sold out faster than the Lady Gaga concert, actually.
Great. So basically, the point I'm trying to make with this video is the diverse nature of sourcing capital through retail, which is right. Is that better?
Yes.
All right. So essentially, financial technology in sourcing capital from retail investors is becoming reality. YieldStreet has been in the business of financial technology since 4 years now. We've got an established platform. We've got more than 200,000 US accredited investors subscribed. That's merely 1.5% of the overall space. US accredited investors amount to 14 million in the US that hold about 20 trillion in liquid wealth. So that means that utilizing technology to reach out to all of those investors in an efficient manner is a key benefit when it comes to funding our transactions, including those in the maritime space. On Tuesday, we've announced a major cooperation between BlackRock and YieldStreet. BlackRock is world's largest asset manager with in excess of 7 trillion in assets under management. That provides a testimony as to the fact that they, one of the leading players in the space, believe in the future of distribution through fintech. So what does that mean for our borrowers? We engage in a number of asset classes, lending in a number of asset classes. That video showed an art offering. Equally successful are our marine offerings being sold in, again, few seconds. So that means that we are able to source efficiently, quickly, capital for our maritime transactions. We first fund those transactions ourselves, utilizing our working capital line, and thereafter we deploy our fintech technology to distribute those to our wide investor base. So reaching to an inexhaustible pool of capital is a benefit for our marine offerings, for our borrowers. The diverse nature of that capital can also be utilized in different risk-reward structures. There is data, if we wanted to create groups of risk-reward appetite and allocate those groups to the specific projects that we fund, of course, including the ship financing effort. And what this really all means for our ship owner friends is that our capital is flexible. We are able to transact very quickly. We are very proud to have a physical presence with our office in Athens since the beginning of 2019. So I think that all sounds good news to our ship owner friends and our advisors advising those ship owners.
Thank you very much, Stefane. Mike, would you like to go on?
Sure. So RMK is an investment bank focused solely on maritime. So when we think about alternative finance, as RMK, we think about the entire capital structure. And in fact, we've worked with most everyone on this stage in one way or another. But I think right now we're probably talking more about our direct lending, which is Ascension finance. And there we're just kind of replacing some of the banks that have pulled out of the market. So this is going to look and feel like traditional shipping bank debt. It's sort of 65% LTV, and it's single-digit cost. So it's not too expensive, so the ship owner can still make money on the investment.
And you, Jeremy?
Thank you, Cal.
Given your track record,
Yes.
we would like you to tell us some things about your offering, but perhaps focusing also on what you think you do better than banks or other financiers.
Okay. We don't like to boast, but we'll try and say something about that. Hayfin is an alternative asset manager. Now, what that actually means is that we invest and manage third-party institutional money. We're not private equity. We invest very much over a longer-term time horizon. Just putting a bit of context on Hayfin overall, we have assets under management of around 14 billion euros across our various strategies. The shipping team, of which I am one member, is one of 3 sector-specific teams within the firm. And in shipping, we actually have invested capital of around about $2.5 billion. I don't actually like the phrase and to describe ourselves an alternative financier. We are actually a direct lender, and we also have direct asset ownership positions. In terms of how we operate, we are sector agnostic. We come to the shipping market looking to build exposure at times when sectors may be weak, and we will be less aggressive as we see sectors move towards up cycles. We like to structure and ensure we structure with sustainable parameters, so that involves an appropriate balance between leverage and cash break even. We will only operate on a bilateral basis. There's never any syndication, and we don't use back leverage. Neither do we have a single product. What we do is structure client-specific solutions for the appropriate circumstance. We work with established operators who will have good track records, and for them we are able to play across the capital stack. This can range from first lien loans through to direct asset ownership. We don't write small deals, so we tend to start at around $15 million, and without wanting to boast, we genuinely have not yet found a transaction that has exhausted our capacity. The largest commitment we have open at the moment, waiting to draw, is $250 million. Now that's on a bilateral basis, and that is something that many banks simply are incapable of doing today. If I give you a flavour of things we've done in Greece, we've done new build financing, we've financed midlife tonnage, and we've actually also done scrap-linked financing on a fleet of VLCCs. So we're able to play across the entire age spectrum of assets. We like to work through a long-term relationship with our clients, so we do have many repeat clients. And in terms of our commitment to the market, whilst we don't have a presence directly here in Greece, we do have 9 people in our team who are solely focused on front office origination roles. What they are tasked with doing, including myself, is listening to our clients and structuring transactions appropriately. Now, I guess what we feel sets us apart from our peers is breadth of capability and depth when it comes to transaction size. We're also acutely aware that the sustainability of our clients' businesses underpins the sustainability of our own business. And so we always set out and hope we're found to be a reliable and responsible transaction partner.
Great. Thank you very much. And moving on to you, George, would you like to tell us the main parameters of your offering? Is it more or less similar to what we have heard? Are there any differences?
Yeah, for the sake of not repeating Jeremy's latest pitch, we have similar structure in the sense that although the majority of what we've done is senior secured debt, we have done also subordinated and preferred equity, and we don't have strict parameters. We pretty much look at anything but passive equity investments. To give a background on EnTrust Global and the Blue Ocean Fund, for those who do not know, EnTrust Global is a $21 billion global asset manager, and the Blue Ocean Fund is a team of 7 focused solely on shipping investments with a combined experience of over 100 years. Our backgrounds include ship owning, operating, banking, amongst others, and we have raised $1.6 billion to date and deployed north of half of that in the shipping industry with a lot of our transactions with ship owners here in Greece. So we have appetite to continue to grow. Our expectation here is that we will continue to fundraise and be very active as ship owners have realized that although we may not be the cheapest source of capital out there, we do provide reliability, speed, creative solutions, and best-in-class execution. And that matters when somebody's in a tight squeeze or when somebody is looking for money very quickly. And with our backgrounds, we feel like we can move very quickly.
Excellent. Excellent, thank you very much. And moving on to you, Robbert, having heard all of the previous panelists, if you could tell us a few things about your offering and also whether the option you offer is the only option for certain owners, or is it the right option?
Well, if it's whether it's the right option or not, it's not, of course, not for me to decide. But now, we as Direct Ship Finance, we offer plain vanilla bank-style senior secured financing. We aim to launch a $400 million credit fund in the next couple of weeks with committed institutional money. If I would define a typical Direct Ship Finance client, that would be a European mid-size privately owned, family-owned ship owner with, let's say, a fleet of up to 20 vessels. We have a clear preference for integrated owners, and with integrated owners I mean owners who are directly involved in commercial management and or technical management. It's something that we value very much. With respect to the assets that we are focusing on second-hand tonnage up to 12, 15 years. We have a clear preference for what I would call the more liquid assets, dry bulk, crude, product, chemicals, LPG. We can look at different asset classes as long as it's classified as what I would call deep sea shipping, but we would do that on a more case-by-case basis. And I believe that speed of execution and being consistent in execution is key, especially if you want to be active in the S&P market. And for that, we developed an online portal for ship owners that allows us to streamline the credit process, the approval process, and the documentation process. We have standardized documentation, loan documentation, and unless an owner's hobby is to discuss loan documentation forever, I believe that will be very time efficient and cost efficient for all parties concerned. I mean, I've been doing this little thing for quite a while now, and I think that ship finance, although it's of course a serious business because we talk about a lot of money here, but I think it's been made unnecessarily overcomplicated over the last decade, and with direct ship finance we have a pretty straightforward product to offer to, among others, the Greek owners. Where do we differ from especially the more traditional providers of ship finance, the banks, not so much compared to the guys sitting at this table today, is, I believe, our underwriting methodology. We focus more on the earning capacity of the underlying asset, let's say cash flow, and maybe a little less than on loan to value. Obviously, within that framework, we have a certain flexibility. In a high market, we can look at higher leverage deals, sometimes in combination with a front-loaded repayment schedule, but at the same time, in a low market, we are there to support anti-cyclical investing with backloaded repayment profiles to support cash flow in early days. I mean, we operate out of the Netherlands. We have a dedicated team with a long track record in shipping and in ship finance. And we understand the dynamics, the cyclicality and sometimes volatility of shipping. And we try to reflect that in a direct ship finance loan.
Thank you very much for that. So we have seen some similarities and some differences between the offerings of our panelists. And let's move on now to an issue that concerns us all, and other panels touched on before, about the environment. And I would like to ask you, to what extent do concerns affecting traditional financiers currently, like Poseidon principles and environmental considerations, have on your principles' decisions? And do your principles require you to ensure that your investments comply with environmental, social governance principles? Mike, may we start with you?
Sure. I think from our perspective, I think the shipping industry is a very heavily regulated industry as it is. Mm-hmm. I don't think the addition of additional rules on the ship owners beyond what has been decided by several global governing bodies is necessarily something that we're going to focus on as a lender. So look, I think the ideas behind some of these things that are in place make sense, but I think a lot of it is a bit of a marketing effort on behalf of some of the larger banks. And fortunately, being a small player, we don't have to deal with some of that.
It would be interesting if it would be possible to have a debate about that with traditional banks, but maybe at another opportunity.
They already left the building.
Yes. Jeremy?
I think, I think the suggestion that these are issues that only affect traditional financiers is actually misplaced, because certainly for us, we are required by our investors to have a broad engagement with our clients on ESG issues. We will have specific discussions around these issues with company management, and we have to go through an ESG process within the firm before we can get to present a transaction to investment committee. We spoke about the Poseidon principles earlier, and it was said, I think it was Philip Wunschman who said it on the previous panel, that this addresses only the E, and in a trilogy of 3, and it's, for us, it's the very broad discussions that we need to have. Now, specifically about the Poseidon principles, it's recognised by the authors of that particular framework that older ships will have what they measure, this higher carbon intensity than will younger ships. And that probably means that for those of us on this panel, that our rankings would appear to be somewhat less favourable than those who are financing the newest, shiniest ships. But that doesn't in any way mean that any of us are a less responsible lender. We care about all these things, and we will address them in our own way.
Okay. George?
So when talking in your question, you mentioned principles, and I just want to point out, as I didn't mention it in my opening remarks, that the Blue Ocean team are the principals. We have full discretion to invest the capital, and when we are on the road fundraising, investors do ask that question, what is the carbon footprint? So it is something that we do take seriously and that we do have to consider when investing. The way we look at it is every ship we lend to, every piece of collateral, we thoroughly review technically to make sure that it is an asset that will not become obsolete when our loans come due in 5 years. Because that's really the issue for us, is what is the refinanceability of the assets we're lending to. So we focus on the technical aspect very much to make sure that our collateral fleet is not obsolete. And when you talk about fuel efficiency, it was about a decade ago now where that was a very big focus for a lot of ship owners. So the average age of our collateral vessel is under 8 years old. The fleet we're lending to is considered fuel efficient based on your standard vessel out there. So it is something we take into account and will moving forward.
Okay, thank you. And you, Robbert?
Running the risk of echoing some of what has been said. Obviously, we take sustainability serious. I mean, that goes for everybody in this room, so also behind this table, I guess. At the same time, we are also very realistic about it. If we look at the E, our focus is on second-hand tonnage, and on second-hand existing tonnage, you can only do so much. That goes for the owner, that goes for the financier, I guess. With respect to the other 2 aspects of ESG, we take that very seriously. If you talk about KYC, anti-money laundering, sanctions and stuff like that, that is a very important element to consider in any credit project that you're looking at. In that sense, I don't think we should differ from any other provider of ship finance, and therefore we value that. Thank you.
Thank you. Okay, we will try to speed up a little bit because we ran a bit out of time to catch up with the delays before. So probably the final question, to what extent is alternative financing becoming mainstream? And to what extent do you think it is still disruptive to conventional mindset in financing? Stefanos, would you like to start on this?
Sure, thank you. I think what is disruptive is financial technology stepping into the space of distribution to retail investors. Now, alternative financing being disruptive, I wouldn't think so. I wouldn't also call it yet mainstream. What is evident with regards to alternative financing is that the list of active alternative, or let me put it in a different way, non-bank debt lenders in the last 3 to 5 years has grown very considerably. So in my count, that's at least 20, if not more, active lenders, alternative financing. Still, senior debt provided by banks will be there for, of course, many years to come. These two are not competing products. Point is that, in my view, alternative financing will grow its significance going forward. That is evident. There are more people recognizing value being added through alternative financing, and it is certainly a space that we see it will continue to grow going forward.
Okay, thank you very much. Mike?
Yeah, I think that's right. I think that's right. I think it is to some extent mainstream already in the sense that I don't think any of us here really feel like we're competing with the traditional banks. I think we're sort of adding a complementary service on either vessels they won't lend to or maybe credits that they won't lend to. And again, that's not to speak of the credit quality. A lot of times that's just whether it's considered a corporate or not. So I think we're seeing more and more. I think the other interesting thing is you look at the people on this table, everyone's kind of been in shipping a long time. I think the idea of alternative finance was, a hedge fund that was coming in and lending, double-digit paper. And for most guys, that didn't work out very well. So I think the people that are in this for the long term, in what's called alternative finance, are really kind of traditional ship lenders that are moving into an untapped market.
Mm-hmm. Thank you. Jeremy?
I think when you talk about disruption, you tend to think of the impact Uber had on the taxi world and perhaps the impact Amazon had on the way we shop. But I think when we look across debt markets generally, the penetration of direct lending has increased in proportion to the way bank lending has fallen away. Now, within shipping, as much as we would love, I think, to be able to say, yes, we're there, direct lending does not yet have sufficient penetration, in my view, to be disruptive. It's very interesting to hear the statistics for the Chinese lessors earlier, because, their sort of volumes, portfolios of £59 billion, dollars, I beg your pardon, it does. It's a much, much more significant contribution than we can currently provide on a collective basis. We'll get there. And I would like to think we hit disruption when our audience's first thought is Hayfin.
Okay, George?
With regards to being mainstream, I think I have to say resoundingly yes. Shipping is $1 trillion industry, of which half is supported by debt. The main banks that lent to the industry 10, 15 years ago, a handful have departed, and with that, approximately $150 billion of debt. So Blue Ocean being $1.6 billion is a drop in the ocean of the actual opportunity. Our capital is needed. On top of that, the public equity markets are not there. So when you're talking about alternative lenders, you typically mean people who have flexibility in how they could structure things. So we are somewhat bridging that gap between the debt and equity that's no longer available. On top of that, the panel before us were the very mainstream banks, and they focused a lot on corporate lending. A lot of those banks will not do a transaction unless there's another source of revenue with the ship owner, whether that be through investment banking or something else. This table here is focused on just the lending relationship, and we don't need that other source of revenue in order to have a relationship. And absent a big bounce back in the public equity markets, I think the alternative lending space is going to be very active for the foreseeable future.
Thank you very much.
I should just add that we wouldn't mind investment banking revenue.
Robbert?
I will be short after everything that has been said already. I think, truly believe alternative lending is mainstream because it's here to stay. But alternative lending comes in different forms and shapes. I think you've seen examples here. And that, I think, is very good. Because although you may argue that the ship finance market is more fragmented, that also creates options and choices for different owners. I mean, if I look at our own proposition, I think where we differ from the more traditional players, if they are still there, is that we have flexibility and we have short decision lines. I mentioned already the non-linear repayment schedules, but we can also look at longer terms, longer profiles. We can look at pre-agreed skip options to support further investments by an owner and stuff like that. And that makes it, I think, interesting for Greek entrepreneurial owners to look a little bit further than just pricing. I mean, you may argue that around the table we will be a little bit more expensive than the good old days, but everybody has to realize that HSH and RBS are no longer there. And rightfully so was mentioned earlier, is that the void of ship finance is important, is there and there to stay for now. And I think that everybody should take the opportunity to really look to find solutions for their specific issues on the table in financing, refinancing, or S&P transactions. And therefore, I believe alternative lending is here to stay and creates added value to the shipping community as a whole. Thank you.
Great. So what I'm keeping from this point is that alternative finance is becoming a mainstream, but is still disruptive. Thank you very much to our panelists and our audience. We will leave you here.